I wish I knew that this was a good deal. That is the frequent comment that I get. I wish I knew what a good deal is. So you're interested in investing in rental properties. Here's the very first thing you need to do to make sure that you're gonna analyze that property correctly. If you've been watching our videos, you know that when we first start off, we start off with the 5-2-1 investment formula. This was the way that you were gonna analyze the properties. Since then, we've advanced and we're now at a 6-2-1 formula. And on today's video, I'm gonna start off with the very first step in analyzing a property. In fact, if you get this step, the other steps are pretty easy. This is the one where I wanna make sure that you understand, and it's known as the gross rent multiplier. I'm gonna talk to you about what it is, how you could calculate it, and how you could use this gross rent multiplier to instantly create wealth in the properties that you're looking to invest. The number one question I get from investors is, Juan, I wanna make sure that I'm making a smart decision. There's so much information that I don't know. I wish I knew that this was a good deal. That is the frequent comment that I get. I wish I knew what a good deal is. The gross rent multiplier is a great start into realizing, are you making a good investment or not? So what is the gross rent multiplier? Let me start off with saying that I'm a CCIM, a certified commercial investment member. I have a degree in accounting, but I spent more time learning how a commercial broker, a commercial investor analyzes properties. And I learned a lot of ways. And what I'm gonna do now is simplify it, because I realized there's a lot of ways that we were taught that are so analytical that up until this day, I haven't had to use. One of those examples is the internal rate of return. None of my clients have ever said, Juan, what is the internal rate of return for this investment property? Now, although I learned that, I know that it's not practical, and for most cases, we're not utilizing it. I understand some syndicators and some larger transactions might look at that as projections in the future, but for those folks that are mom and pop independent investors, we're not looking at that. But what are we looking at? And that's the gross rent multiplier. The gross rent multiplier looks at one thing, pretty simple, the gross rent. So let me give you guys an example. In this example, we're gonna look at a 4-unit building. Now, if you're looking to buy a 2-unit building, it's gonna be the same. If you're looking to buy a house as a rental, you're gonna apply the same step. If you're looking to buy a 12-unit building, we're gonna do the exact same thing. And this is look at the gross rent coming in for a specific property. So let's start off with how to utilize the gross rent multiplier. Again, this is the first step. It's a very practical step. And where some people might say the gross rent multiplier, it's not sophisticated enough. And that's wrong. And I challenge that because I know a lot of successful real estate investors that most times, although there's different ways to measure how a property is going to perform, some of them can quickly make a decision off of this one thing, off of what is the gross rent multiplier. Let me give you an example. Let's just say that we're analyzing a 4-unit apartment building. So anywhere you might be, whether it's Florida, North Carolina, New York, Ohio, Montana, it doesn't matter. There's gonna be apartment units for sale, rental property for sale, and I want you to pull what are the rents on this property. So I'm just gonna give you an example now on a 4-unit building. Let's just say that one of the units brings in $1,350. The 2-bedroom brings in $1,500. You have a 3-bedroom that is $1,700, and then call it a studio, and that's at $950. This is something you could do. And in fact, if you want to be a skilled investor, I'm going to challenge you to actually practice this. Practice calculating the gross rent multiplier on a lot of buildings. That's how you're going to get good. That's how I got good. And so here's some income. So this is the income on a 4-unit building. What do we do with it? Obviously, we're going to add it up on a monthly basis, and then we're going to come up with the annual, and then I'm going to start working off of there. So let's walk through this. Currently, we're bringing in $5,500 a month. And on an annual basis, $66,000. So now we know our gross annual income. That's part one. Part two is we're gonna take this income and we're gonna times it by a number. That's gonna be the multiplier. That's how we're gonna come up with value. So the gross rent multiplier, again, it's a terrific tool because it's a simple tool, but it's a true, accurate tool. So we're gonna take the 66,000 and there's a lot of numbers that we could multiply it against. And let me give you an example. Okay, so now what we're doing is we're taking the annual income that we know a current property produces, and we're gonna multiply it times a multiplier. In this case, I'm looking at 9, and I'll tell you why I chose that. and that's gonna give us a value for the property. $594,000 might be the value if you were one that was looking to buy something at a 9 times. So consider this our multiplier, okay? And as the multiplier goes up, the value goes up, okay? So this is working down this way. Here's what I wanna show you. The reason why I said a lot of investors could make a wise decision, a sage decision, is because if you know your market, you know what multiplier you should be in. Okay, so if you were buying a property in Wisconsin and you called me and said, hey Juan, can I have your advice? I'm buying a 4-unit building. And my first question might be, well, what's your gross rent multiplier? And you might know what that is for the property based on the price. But do we know that it's a good deal? Possibly not. Because what I want to know is if you were in Wisconsin, what do other fourplexes trade for on a gross rent multiplier? And so this is an easy way to figure this out. And we're kind of working backwards on other similar properties that have sold in that area. In the area, because if we get out of the area, it's going to be a hard comparable. Let me give you an example. So I'm making this up. If I'm in Wisconsin and the gross rent multiplier in that area for a 4-unit building is 9, that means that we've gone back, we've found the properties that have sold, and we've ran the numbers to come up with a multiplier. Because what I want you to do is to either buy at the same multiplier, or if we're smart, you buy under the multiplier, okay? So in this scenario, let's just say that in Wisconsin, everything sells at a 9 times multiplier. That means that if your fourplex is making $66,000 and everything else in that area sells at a 9, then this would be the price that most people would pay, right? So that would tell me that you're buying this at market value. Nothing wrong with that. It's probably a good decision, but we could instantly tell, are we buying it at, above, or below? Let me give you a little more details. What if everything was selling at 9, but for some reason you were paying 10? In this scenario, you're now paying $660,000, but an appraiser, another investor, a broker like myself might look at it and say, well, we don't know why you're overpaying for that property when clearly we could show data that everything sells at a 9. In my past videos, I have gone through this process and I realized that I really wasn't showing you exactly why these numbers were important. So the gross rent multiplier works in a few ways. It's gonna tell me, am I overpaying for it or am I getting a good deal? So typically, a lot of people will say, Juan, when do you buy something? When is it that you get excited about a property? And I'm gonna show you right now. This number here, market derived. I can't make this up. I cannot make up the multiplier in any neighborhood. Why? Because there's enough data behind it to know what that is. If you're in Southern California and if you're working with my team, you might ask me, what's the multiplier in that area? And every city is going to be different and neighborhoods within the city are going to be different. In Long Beach, we have like 70 something neighborhoods and we're going to have a lot of multipliers around. So it takes a little bit of analysis. So if you're working with us, we got your back. If you're not and you're in another area, hopefully you're working with a skilled professional. When you ask them, what is the multiplier in the neighborhood? They'll do a little research. Some of them might be skilled enough where they have it memorized, but they might have to give a little research for you, show you what the multiplier is. Again, this is market derived. You cannot make this number up. Well, you can, but then you're gonna make a bad decision, which is the purpose of this video, is to show you how we're gonna make a smart decision. So, if I'm looking at a property and I know that the area, everything sells at an 11 times. So no matter what the income is, we're selling at an 11 times. Well, what I try to do is try to buy under that multiplier because that's what I say we're buying into equity. So let's just say that I'm looking at a neighborhood. I know for a fact that it says at 11 times, or your broker showed you, that didn't tell you, they show you that it sells at an 11 times. If I could buy under that multiplier, that's where we're making money. So in this case, I could probably project that the property should be worth $726,000. If I'm able to get it at a 10 times multiplier, you could see the difference. And all this is equity. This is equity. That's what we talk about buying into equity. That means I'm paying less than what I believe the property is worth. Am I making a quick decision? Absolutely not. Am I researching the neighborhoods? 100%. So again, gross rent multiplier, market derived. We can't make it up, but we could use this to our benefit. We could use the gross rent multiplier to buy smart, buy into equity, and know going into it that, look how much money we've made on day one. So when we're buying into equity, I want to show you how that looks. There's a difference of $66,000 in these two, right? That's a whole year's worth of rent that you're making on day one because you're using this simple method. So this is the second way that I want you to utilize the gross rent multiplier moving forward. I'm going to give you a scenario. Let's just say that after year one, we decided to buy it. We bought it for $660,000, but we know for a fact that it's worth $726,000. Okay, this was a smart purchase. Now I want to show you what we could do with the rents in the future and use it's also referred to as the GRM. So gross rent multiplier, they'll call it a GRM, okay? Let's just say that I'm able to raise the rents. Let's just say that we do 100 on each unit, okay? This is after year one. You've made some improvements to the building. And now on a monthly basis, we know that you're gonna make an additional $400 a month, which equates to $4,800 a year. A lot of us might think that you've increased the value of your real estate by $4,800 a year. And I could see why someone would think that, but that's not how it works. That's not how it works because we know that dollars equate to a multiplier in a property like this. So now what we do, we go back to the prior year where we looked at and we said, in this area, every dollar is on a multiplier. And in this case, using the same example I used earlier, it's 11 times. What I do now, I take my $4,800 a year and I multiply it by 11, because that is my multiplier. And I'm going to show you how, once again, you could add equity to the property that you own. This is the increase in annual rents that you've done as a landlord. We're going to multiply it times the multiplier in that neighborhood. Now, instead of increasing the value by $4,800 a year in revenue, really what we've done from an equity perspective, from a increase in value perspective, we increased another $52,800 a year. Folks, this is how wealth is created. This is how we could use numbers to our benefit. So in the first example that I showed you, we're buying into equity. We're analyzing the market. We figure out what the gross rent multiplier is. We're gonna try to buy underneath that so that we have that equity. And then by effectively managing the property, we're able to add value once again to the biggest dollar line. It's not so much the cash flow, but it's what the cash flow multiplier gives us. In this case, you're gonna add another $52,800 a year. So there you have it. Two quick ways that you could use the GRM, the gross rent multiplier, to your benefit. I recommend that you try this. This is so simple. I know it's simple, but successful investors who know their markets always know. That could be the first question that they ask me. If I call them, I'm like, hey, I got this good deal. They'll say, what's the multiplier? And I'll give them the multiplier. They'll say, that's a good deal. And they will know quickly. So this is like a quick way to know a good deal. So, but what does that mean to you? That means you need to know your market. You need to know what the GRM is in your area. Now, you could play around with every property that's on the market and you could go calculate the GRM. Sometimes good real estate brokers will give the number for you. Other times they won't, but I would encourage you to have you actually calculate this. Have you actually work the numbers? Have you come up with the GRM in the neighborhood so that you start getting familiar with the concept, with the numbers, and really get confident in these numbers? And that's what's gonna make you a good real estate investor. So there you have it. Step one on how to properly, successfully analyze a rental property in your area. If you wanna learn our other 5 methods, make sure to like, comment, and subscribe. Until next time, That's all for now.